Hello, I'm Mike Puglisi, and joining me today is my colleague Sarah House to talk about Wells Fargo's monthly economic outlook. So Sarah, we had a pretty good year in 2023 for economic growth, but there have been some signs that we've slowed down through the first half of this year. What are some of the sectors that have driven that deceleration in the economy year to date?
You're right, Mike. So we saw GDP growth very strong in the second half of last year, so roughly a 4% annualized rate. But since then, we've seen the economy lose momentum. So in the first quarter, we saw GDP growth of just 1.4%. In Q2, it looks like that'll probably be roughly similar at around 1.5%, which is a step down from what we were expecting in our June forecast, which was probably GDP growth in Q2 closer to 2%. And a big reason for that downshift is we think we'll get a bigger drag from net exports as we've seen export growth continue to falter under a pretty tepid global growth environment and the strong dollar. We're also seeing continued weakness in residential and non-residential outlays as builders struggle with the higher rate environment. But a big part of the moderation has to do with the consumer. So we're seeing increasing signs of consumer fatigue. That includes things like non-discretionary spending outpacing discretionary spending, credit growth slow as we're seeing consumers less able or less willing to use credit in this rate environment. And so with that, we have seen consumer expenditure outlays slow to under a 2% annualized rate these past few months compared to somewhere closer around 2.5% over the past year. Now, Mike, this weakness in activity, it does seem to be feeding into the jobs market. So what in the labor market has stood out to you recently?
Yeah, what I would say on the labor market side, Sarah, is that you've really seen kind of a broader base slowdown there as well. So take just the headline pace of job growth. Over the past 3 months, we've added an average of 176,000 jobs per month. That's the slowest pace we've seen in more than 3 years. You've seen it in an increase in the unemployment rate, which has ticked up to 4.1%. Nothing alarming, nothing terrible, but again, just an upward trend on unemployment. At the same time, you're seeing a downward trend on the pace of job growth. And even some of the other labor market indicators, like the number of job openings per unemployed person, or you see things like layoffs that have been maybe ticking a little bit higher over the past couple months, the plans for small business hiring that have weakened. Just across the board, you're seeing a labor market that has really lost a lot of its heat and come back into much better balance relative to the very tight labor markets that we were seeing 12 or 24 months ago. So an economy that's decelerating, a labor market that is in much better balance when it comes to supply and demand. How is that feeding through on the inflation side, Sarah?
Yeah, so we have started to see inflation slow again after what was a flare-up in the first quarter or so. So we saw in June, for example, the core CPI came in with its smallest monthly increase in about 3 years. Now, some of this had to do with the fact that you did see big drops in some of the more volatile categories like airfare or hotels or used cars, but we really saw a broadening slowdown in terms of the inflation numbers, including things like the housing part of inflation begin to slow more materially. And when you look at the entire basket, we actually saw the smallest increase in the median CPI in about 3 years. So we are starting to see that broadening slowdown, and I think it can continue as we move through the second half of the year when you look at just tamer growth in input costs, including wages, as we have seen the jobs market soften as you indicate. And when we look at the core PCE deflator, so this is the Fed's preferred measure of inflation, so we revised down where we think it'll end this year on a Q4 basis. So we're now looking for the core PCE deflator to be up just 2.6% compared to 2.8 in our last forecast. And that's actually consistent with about a 2.2% annualized rate of growth in the second half of this year. So getting pretty close to the Fed's target. So let me throw this back to you, Mike. So given the improvement that we're seeing in inflation, but also that softening in the jobs market, how does this affect our outlook for the path of Fed policy as we move through the remainder of the year?
Yeah, well, relative to last month, we haven't made any changes. So we still expect the Fed to first start cutting the federal funds rate by 25 basis points at its September meeting, with 25 basis point rate cuts at every other meeting after that through 2025. Now that hasn't changed, but what I do think has changed is the balance of risks and some of the conviction. where I think both us and financial markets feel more confident that that first rate cut is in fact coming in September for the reasons that you just outlined. Inflation that's maybe not all the way back to the Fed's 2% target, but is clearly continuing to get closer and closer. A labor market and an economy more broadly that is losing some momentum, losing steam. And I think that puts the Fed in a position where, probably not going to start cutting rates at its next meeting on July 31st at the very end of this month, but probably teeing up that first rate cut in September. Now, again, I think this is starting to be somewhat well telegraphed. I don't think you're going to see, major moves down in intermediate to longer term yields when the Fed starts cutting rates, if they do in fact do so in a couple of months. But you will, I think, slowly but surely start to see a little more of a normalization and rates coming down across the curve. Sooner or later, you start to see the curve becoming a little less inverted. But in terms of the Fed forecast, it has not changed. We're still expecting September to be the first rate cut. And I think our conviction on that is higher than it was a couple of months ago based on these latest economic developments.
Well, thank you, Michael, and from all of us at Wells Fargo, thanks to everyone for joining us. Please tune in again next month as we discuss the latest developments in our monthly economic outlook.